Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, we begin in North America. In a dramatic escalation in his global trade reset, in recent days, US President Donald Trump announced plans to double tariffs on steel and aluminium imports from 25% to 50%, effective the 4th of June. Tomorrow. The move, unveiled during a rally in Pennsylvania, comes as Trump seeks to protect domestic metals production and court blue-collar voters ahead of the 2026 elections. Quote, "We're going to bring it from 25% to 50%, the tariffs on steel into the United States of America, which will even further secure the steel industry," end quote, Trump told the crowd, touting a $15 billion partnership between Nippon Steel and US Steel. He vowed to build a tariff quote, fence, end quote, around American steel, claiming the higher levy would block foreign competitors. Quote, "At 25%, they can sort of get over that fence. At 50%, they can no longer get over the fence," end quote. Canada, the largest supplier of steel and aluminium to the US, denounced the move as, quote, "catastrophic," end quote. The president of the Canadian Steel Producers Association warned of severe supply chain disruptions and mass job losses, expressing, quote, "Steel tariffs at this level will create mass disruption and negative consequences across our highly integrated steel supply chains," end quote. Canadian Prime Minister Mark Carney, who visited the White House just weeks ago to reset strained relations, pledged a, quote, "dollar for dollar," end quote, response targeting US steel, aluminium, and additional goods worth billions of Canadian dollars. European leaders also criticized the move. The European Commission described the tariff hike as an act that, quote, "adds further uncertainty to the global economy," end quote. The announcement comes just days after a US trade court ruled that many of Trump's tariffs were illegal, although sectoral levies on steel and aluminium were unaffected. Meanwhile, the US dollar edged closer to a three-year low on Monday amid mounting concerns over the nation's ballooning debt and disappointing manufacturing data. The greenback dropped 0.7% against a basket of major currencies, nearly reversing levels last seen in early April following President Donald Trump's Liberation Day tariff hikes. The ISM manufacturing index for May fell to 48.5, below the 50-point threshold, indicating expansion, marking the fourth consecutive monthly decline and signaling deepening cracks in the US industrial sector. Despite a brief rebound, the S&P 500 ended the day up just 0.4%, weighed down by concerns over slowing growth and renewed trade tensions with China, something that we discuss in detail in today's episode of China Update, my other channel. Government bond markets also felt the strain. Yields on 30-year US Treasuries rose 3 basis points to 4.97%, while demand for long-term debt remained soft, as traders absorbed Treasury Secretary Scott Bessent's reassurances that the US would not default. Yet warnings from JP Morgan CEO Jamie Dimon that the US bond market could crack under the weight of rising debt added to investor jitters. The dollar's broad decline was compounded by a surge in prices for steel and aluminium due to the moves that we just covered. Aluminium prices soared, with the Midwest regional premium jumping 54%, while steel futures rose 14%. Foreign reserve strategists and major banks predict further weakness for the dollar. Morgan Stanley projects a 9% drop in the US dollar index to 91 by mid-2026, while JP Morgan, Wells Fargo, and Goldman Sachs anticipate continued depreciation amid expected Federal Reserve interest rate cuts, slowing growth and trade policy uncertainty. Morgan Stanley, in a note today, expressed, quote, "a medium-term narrative around a weaker dollar is building," end quote, with investors hedging exposures and reassessing US asset holdings. With trade and tax uncertainties deepening, the dollar's decline could accelerate, reshaping global asset allocations in the months ahead. Next up, we move to Europe. Poland's recent presidential election has thrown its economic future into uncertainty, as nationalist candidate Karol Nawrocki's narrow victory threatens to upend the reformist agenda of Prime Minister Donald Tusk's centrist coalition. Nawrocki's win complicates Tusk's efforts to align Poland more closely with the European Union's mainstream economic policies, casting doubt over the country's market-friendly trajectory and raising risks for its financial assets. Since Tusk's coalition ousted the Nationalist Law and Justice (PiS) party in late 2023, Polish markets have rallied, with the WIG20 stock index surging 61% in dollar terms and government bonds returning 28%, one of the strongest performances among emerging markets. Investors responded positively to Tusk's pledges to restore judicial independence and unlock billions of euros in frozen EU funds. However, the election outcome has now clouded that outlook. Naroki, a conservative historian with limited political experience, secured 50.9% of the vote, defeating his opponent, a centrist Warsaw mayor, by a slim margin. His ascent signals a renewed momentum for nationalist forces in Poland. This could result in deeper divisions within Tusk's three-way governing coalition, potentially destabilizing both politics and markets. Reports suggest Tusk may consider calling a confidence vote to shore up support amid rising tensions. Financial markets reflected this uncertainty. The Polish currency initially dropped as much as 0.5% against the euro on Monday, before stabilizing 0.2% lower. While the currency's move was modest, it underscores growing investor unease. Quote, "The result will likely add to elevated instability in an increasingly fraught geopolitical environment," end quote, said Tusk's Minister of State Assets. Beyond domestic challenges, the election result reverberates across Europe. Poland, the EU's fifth largest economy and a major defense spender, plays a critical role in supporting Ukraine and resisting Russian aggression. A weakened reform agenda could delay judicial reforms essential to unlocking EU funds, potentially slowing infrastructure investment and undermining investor confidence. As Poland's economic growth hinges on EU support, continued instability and policy gridlock threaten to erode the recent market gains and put the country's long-term prospects at risk. However, it is too early to make such a call. The next 12 months should give us an idea of just which direction Poland is heading in. If you want to be on top of the most up-to-date analysis on major markets from around the world through a balanced digest and sober and grounded analysis as we move into this new period of global uncertainty, make sure you're subscribed to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally for today, and speaking of elections, South Korean voters headed to the polls today, Tuesday, local time, in a high-stakes presidential election that could reshape Asia's fourth largest economy, amid ongoing domestic and international turbulence. Indeed, by the time this comes out, we may already know the results of this election. The vote follows the removal of former President Yoon Suk-yeol, who was impeached in April for his failed attempt to impose martial law, marking South Korea's most severe constitutional crisis in decades. The two main contenders, opposition Democratic Party's Lee and ruling People Power Party's Kim, offer starkly different visions for reviving South Korea's struggling economy. Lee, a progressive former labor lawyer, promises stronger labor protections, more government spending, and constitutional reforms to tackle economic inequality and corruption within South Korea's powerful conglomerates. Meanwhile, Kim, a conservative, business-friendly candidate, has pledged deregulation, support for small and medium enterprises, lower taxation, and a push for nuclear power to secure energy stability. Economic policy will be a top priority for the next administration as South Korea grapples with a shrinking economy, compounded by trade tensions with the US. The new president will face immediate pressure to renegotiate tariffs with Washington as US President Donald Trump's administration has imposed steep levies, 25% tariffs on South Korean exports, including semiconductors, cars, steel, and aluminium, with the last two, of course, about to rise again. While a 90-day suspension offers a temporary reprieve, the leadership vacuum in Seoul has stalled progress in negotiations, casting uncertainty over the trade-dependent economy. Lee has signaled a more measured approach to trade talks with Washington, advocating for a balanced foreign policy that also engages China and Pyongyang. Conversely, Kim has indicated a readiness to secure a deal with the US swiftly, aligning with Yoon's previous hardline stance on North Korea and favoring a NATO-style nuclear sharing arrangement with the US. Beyond trade, the next president must navigate rising public discontent over economic stagnation and political infighting. With over 15 million early votes cast and high voter turnout on polling day, the election's outcome will set the tone for how South Korea manages its economic recovery, regional diplomacy, and the complex balancing act between its US alliance and relations with Beijing. With this decision, the stakes for South Korea's economic future and its place on the global stage have never been higher. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you for a new episode tomorrow.